Welcome to Tesla Daily News Podcast. I'm glad you're here. Today is April 15th, 2026, and we're breaking down the Tesla headlines that could move sentiment, margins, and ultimately the stock. On deck, Tesla's Shanghai numbers and the new Optimus angle, a major regulatory opening for full self-driving in Europe, fresh analyst action from UBS, and one big warning sign investors should not ignore: the growing gap between production and deliveries. Story 1. Shanghai is quietly becoming the center of gravity for Tesla, and maybe for robots too. Tesla's China president, Alan Wanghao, said the Shanghai Gigafactory has the potential to construct humanoid robots in the future. That matters because Optimus is now central to Tesla's physical AI narrative, the part of the story bulls think justifies Tesla's valuation premium. Here's the context investors should focus on. Tesla needs two things at the same time: lower cost per vehicle and a credible path to scaling non-auto revenue streams like energy storage, autonomy software, and robotics. Now the details. Shanghai is already Tesla's largest production base. In 2025, Giga Shanghai produced about 851,000 vehicles, about 52% of Tesla's global total, while Tesla's global deliveries fell 8.6% to 1.63 million units. Operationally, Shanghai is showing momentum into 2026. The article cites March deliveries from Shanghai of about 85,670 units, up 46.2% from February. And in the first quarter of 2026, Shanghai delivered about 213,398 vehicles, up 23.5% year-over-year, representing about 59.6% of Tesla's global deliveries in the period. And don't forget energy. Tesla's Shanghai Megafactory targets 10,000 megapacks per year. Each megapack can power about 3,600 homes for 1 hour. The factory's annual energy storage capacity is cited at about 40 gigawatt-hours. Impact for Tesla: if Shanghai can keep vehicle output high while Tesla pushes energy storage and eventually robot manufacturing there, it strengthens the scale and execution piece of the bull case, especially if Optimus ever becomes a real product category. But investors should separate near-term cash flow drivers, like Model Y and megapack volumes, from longer-term optionality, like humanoid robots. Takeaway: Shanghai is doing the heavy lifting today. Any credible update that ties Shanghai's manufacturing machine to Optimus scaling is a valuation narrative booster, but it's still early, with some estimates saying Tesla shipped fewer than 500 general-purpose humanoid-type robots in 2025. Story 2. Europe just opened a door for full self-driving, and it could be a software revenue catalyst. Hook. After years of regulatory friction, Tesla's full self-driving, Supervised, has been approved in Europe, starting with the Netherlands. Context: FSD is high-margin software. Tesla wants more recurring revenue per vehicle because vehicle margins are under pressure from competition and pricing. Details from the reports: Tesla worked with the Dutch Vehicle Approval Authority, the RDW, over roughly 18 months. RDW reviewed extensive real-world testing, including close to 1 million miles with FSD Supervised activated and trials involving about 13,000 people across multiple European countries. The approval is only in the Netherlands for now, and the RDW is emphasizing the system is not autonomous. The driver remains responsible. Tesla also made Europe-specific changes to reduce misuse risk. Dutch owners must pass a mandatory safety quiz before enabling FSD. And certain aggressive driving profiles available in the US version were removed in favor of a simpler maximum speed setting. Tesla claims that with FSD Supervised enabled, collisions can be up to 7 times less likely per kilometer than manual driving. Critics cite US incident data and raise concerns about the camera-only approach versus sensor stacks that include radar and LiDAR. Impact for investors: the big question is conversion. If Europe becomes a meaningful FSD subscription market, it's incremental gross margin without building another factory. TechCrunch notes the FSD subscription is $99 per month. But there's a catch that matters for customer satisfaction and churn. Tesla's new self-driving app and some new features are only available on hardware for vehicles, the newer computer platform. That could limit near-term adoption and trigger backlash from owners on older hardware. Takeaway: Netherlands approval is a real regulatory milestone. The bull case is higher software attach rates in a large market. The bear case is slow rollout across Europe, hardware fragmentation, and ongoing safety scrutiny. Story 3. Tesla is gamifying FSD usage, and it's more important than it sounds. Hook. Tesla is adding usage tracking, streaks, and one-tap subscribing in a redesigned self-driving app. Context: when Tesla talks about the future, it's autonomy, robot access, and AI. But on the income statement, the near-term win is getting more people to pay for FSD Supervised. Details: Tesla teased a new app that lets owners subscribe to FSD with one tap and view richer stats, including bar charts of FSD usage and multi-day streaks. This adds a behavioral nudge. If owners see they're on a streak, they're more likely to keep using the feature and maybe more likely to keep paying. The limitation. The feature is only for vehicles with hardware 4, also called the A14 chip, which started shipping in early 2023. Impact. This is a classic retention and monetization play. It won't change deliveries next quarter, but it can improve software revenue per vehicle over time, which matters a lot if unit growth is volatile. Takeaway. Watch for Tesla to introduce more flexible pricing, like short-term or pay-per-mile FSD access. Even rumors of that show Tesla is thinking like a software company. Story 4. Analysts are shifting, and the message is, valuation is now more balanced after the sell-off. Hook. UBS upgraded Tesla from sell to neutral and set a price target around $352. Context. Tesla stock has been down more than 21% year-to-date, and that drawdown changes the risk-reward calculus for analysts. Details. UBS argues the stock's decline has priced in much of the bad news, and the trade-off is now more even between near-term headwinds and longer-term physical AI upside, meaning robotaxis and Optimus. UBS also flagged near-term risks, weaker EV demand, an elevated investment cycle, and slower-than-hyped progress in robotaxi rollout and Optimus timelines. Impact. Upgrades from well-known bears can stabilize sentiment, especially into earnings, but they do not fix fundamentals. What matters most is whether Tesla can protect automotive gross margin, grow energy, and show measurable progress in software attach and autonomy capability. Takeaway. Treat the UBS move as a sentiment signal, not a fundamental all clear. Story 5. The demand and inventory signal investors can't ignore. Hook. Tesla may be producing far more cars than it's delivering, and that's a margin risk. Context. When production outpaces deliveries, inventory builds. Inventory builds usually mean one of two things. Demand is softer than expected, or logistics and distribution are constrained. Either way, it can force incentives and price cuts. Details cited in Croatian reporting. Tesla produced more than about 408,000 vehicles in the first quarter of 2026, but delivered around 358,000, implying roughly 50,000 vehicles not delivered in the quarter. Impact for Tesla. 50,000 units is not a rounding error. If this gap is real and persistent, it points to pricing pressure, working capital drag, and tougher conversations on the next earnings call about demand elasticity. This also connects to another U.S. trend. Electric pickups are stalling. Business Insider reports Cybertruck sales fell 45% year-over-year to about 3,500 units in the first quarter of 2026. The broader electric pickup category dropped to about 4.6% of the EV market. Takeaway. Watch incentives, leasing deals, and regional pricing. The fastest way for Tesla to protect earnings in a softer demand environment is cost reduction and mix improvement, but pricing still drives the headline. Story 6. Macro tailwinds. Oil shocks are pushing consumers toward EVs, but competition is intense. Hook. Rising fuel prices tied to the Iran conflict are reviving EV interest in multiple markets. Context. Oil price spikes are one of the most reliable catalysts for EV consideration, and Tesla benefits when the total cost of ownership argument becomes obvious. Details. In the UK, EV inquiries rose about 23%, with used EV searches up around 30% since the conflict began, according to CarWow data cited by The Independent. The Tesla Model 3 was among the most in-demand EVs. In Southeast Asia, reports show EV sales rising, with Vietnam's VinFast seeing a big jump in March sales and BYD gaining traction in multiple markets. Impact. This is the good news. Demand interest can rise quickly when fuel prices spike. But the competitive landscape is more crowded than ever, especially with Chinese brands pushing price and feature value. Takeaway. Tesla still has brand and charging network advantages, but pricing power is not what it was in 2021. The margin story matters more than the volume story right now. Let's wrap it up. Today's big themes for Tesla investors. Shanghai is executing and could become a manufacturing base for Optimus. Europe is opening up to FSD Supervised starting in the Netherlands. Wall Street sentiment is shifting slightly with the UBS upgrade, and the biggest red flag is the potential inventory build, production running ahead of deliveries. For tomorrow, keep your eyes on two things. Any new data points about demand and incentives, and any hints on how quickly FSD Supervised expands beyond the Netherlands, because software revenue is the cleanest margin lever Tesla has. If you found this helpful, subscribe to Tesla Daily News Podcast for an 8 to 10 minute data-driven roundup every day, and share it with a friend who follows Tesla. See you tomorrow.